Hello, everybody, and welcome to Finance Magnates webinar today. My name is Celeste Skinner, and I'm an FX editor here, and I'll be moderating this panel, which is titled Offshore Companies and the Voyage to Tighter Regulations. I'm really excited to have with me three industry participants with extensive knowledge of offshore jurisdictions, and our speakers are Jim Manzak, the Director of Bahamas Offshore Services, Tal Itzak-Ron, Chairman and CEO at legal firm Talron Dryham & Co., and Graham Watkins, the CEO of Value Trades Limited. Our discussion today is going to focus on offshore jurisdictions, which since the implementation of ESMA's product intervention measures have experienced a real boom as traders have been seeking warmer waters and more favourable trading conditions. However, following this boom, local regulators from these island nations have been focusing more on their FX and CFD industries and have been increasingly adopting new regulation, with some of the most recent changes coming out of the Bahamas. So what will the future be for offshore jurisdictions, and what will their role be in the FX space going forward? These are some of the questions that we're going to be answering today. And after our discussion, we're going to open up the floor for questions. And so we'd really love to hear from you during today's presentation. So if you have a question for any of our speakers at any point during the discussion, please feel free to leave us a comment. And if we don't get to your question today, then we'll be sure to follow up afterwards. So let's get this conversation started. And I'd really like to start off with a recent change in the Bahamas, but actually, sorry, before I do, I'm going to just pass the floor quickly to all of our speakers. If you can all just introduce yourself quickly. So I was just too excited to jump straight into the conversation. I forgot about introductions. So Jim, can you quickly introduce yourself?
I'm Jim Manzak, an industry veteran, more than 15 years, and the Director of Bahamas Offshore Services.
And Tal?
I'm Tal Itzak-Ron. I'm from Tel Aviv. Probably the only place from us that are not in the lockdown anymore. Hopefully all of us will be soon free. And I'm in the industry, and the financial industry and the gaming industry since 2003 from Talron Dryham & Co. law firm.
And Graham.
Hi, I'm Graham. I'm the CEO of Value Trades, a UK FCA regulated and Seychelles FSA regulated Forex and CFD brokerage.
Okay, perfect. So now we can jump straight into the conversation. So as I was saying before, I'd like to start off with a recent change that we've seen in the Bahamas, which we've reported on quite a lot here at Finance Magnates. And it actually saw the local regulator implement leverage restrictions of 200 to 1. And they also banned binary options in addition to a range of other changes. And this was a really big and quite bold step from the regulator. And Jim, I'll start with you. We've actually spoken a lot about this previously, but what message do you think the Securities Commission of the Bahamas, which is the local regulator there, was trying to convey when they developed these new regulations?
Sure. The Securities Commission is making a statement that they're a premium jurisdiction, that they're not like other offshore jurisdictions that have either light touch or very little regulation. I've been working with the Securities Commission since the beginning, since the first couple CFD applications were made back in 2017. And the executive director there realized that they were really not very well prepared for this. It took them a while to really understand the business. And that after a while, they would definitely need to update their rules, which for broker-dealers have been in place since 2011. And the rules actually hadn't been even written since 2012. So you can see that the industry progressed quite a lot, and through the ESMA implementation, with more brokers choosing the Bahamas and flying there, the executive director really needed to basically draw a line in the sand.
And Graham, from a broker's perspective, obviously offshore jurisdictions can be really attractive for traders because a lot of them don't have any leverage restrictions, or really high leverage is allowed, and then obviously that attracts brokers. So with the Securities Commission implementing leverage and banning binary options and all the other changes, what is your perspective from a broker? What do you think about the changes?
So I think obviously in the short term they're going to see a lot less applications, as particularly straight after ESMA and even continuing now, it's not so much that a broker is choosing where they want to be regulated, and more they're just running to give me the regulatory stamp, but let me do whatever I want. So in the short term, I'm sure they're going to see less applications, and brokers will continue to look for where can they get the highest leverage, the least restrictions. But actually, for the medium and long term, I think it's probably a reasonably strong move, because what we're worried about is if there are no restrictions, you're going to let bad players in. The more bad players you let in, eventually you have some form of blow up scandal, someone's run away with client money, and then that's going to taint the whole jurisdiction and possibly bring sort of more foreign restrictions on that jurisdiction and how they can operate. So I think right now everyone is still chasing the higher leverage, the less restrictions. But over time, I'm sure there will be a gradual preference to those jurisdictions that can hold on to some form of good control premium perspective in the market.
And at the same time that the regulator in the Bahamas introduced these leverage restrictions, they also had new fees passed to have a CFD license, which Tal and Jim were also discussing this recently, which makes the annual cost of holding a CFD license in the Bahamas drastically more expensive. And Tal, you have referred to the Bahamas as a Plan B jurisdiction. Can you kind of elaborate on this and what you kind of mean by this?
Well, Bahamas, and we have in our firm, we call it the Plan B or the B jurisdictions, and that considers Bahamas, Belize, Bermuda, and Barbados. Okay, all of these jurisdictions start with the letter B. We call them Plan B. First of all, it can be nice places to go for surfing, for diving. You know, when the world was open, it was great places to visit. And also, it's a nice place to register your company. But if you look at the practical legal sense, on the banking sense, I don't find any benefit in neither of these jurisdictions. I will explain. You know, Bermuda, there are many companies who are just registering there without an effective regulation there. But they just use it like using a Marshall Island company or a St. Vincent company. But if you look what happened in the Bahamas was practically very useful. But now when the cost is so high, when the leverage restriction it makes it very unpractical for many brokers, I don't find it a really good move. Now, I do understand the idea to regulate the industry. I do understand the idea why to safeguard the funds and make them segregated and make sure, as Graham said, that all the bad boys will go out. But in the end, I don't believe that many people will continue working with the Bahamas. And even though they, in the industry, they now place them in a place on a very high level, I don't think at the end of the day it will be very, very practical to brokers in Bahamas.
And Jim, obviously you really work very closely with the Bahamas, and obviously know a lot of people within that space. What is your take on it?
Well, for those that have made the investment in the Bahamas, the 20 or so brokers that are regulated there or licensed there now come from kind of varied background. There are some really well-known, very well-established names. And then there are some others that are like startup brokers. And with the leverage restrictions and with the new fees, the fees have basically changed the cost of operating in the Bahamas from the regulatory fee basis from about $16,000 to more than $230,000 per year. So you can see just on the fees alone that smaller brokers or the startup companies are not going to come to the Bahamas. The executive director and the commission and the government, I believe, did this on purpose to ensure the good reputation of their jurisdiction by keeping the smaller, less experienced operators out, the bad operators, and truly positioning Bahamas as a premium jurisdiction for the bigger, better well organized, well run brokers.
Jim, I don't think, and you said now, the smaller, you said it in the same sentence, they want to put the bad actors out. They want to put the small. The small and the bad isn't the same, you know? If someone prefers to pay 41,000 euro for the same thing that he gets in Vanuatu, it doesn't mean that he's smaller than the guy going from the Bahamas. It means that he wants to make more clever use of his funds and his money. And I really like what happened in Vanuatu in the last 4 years. I think that Vanuatu became the preferred licensed jurisdiction for offshore brokers in the last 4 years. Maybe, you know, Seychelles and Cayman are also there in the same area, but I think it's Vanuatu, Seychelles, and Cayman. These are the jurisdictions that proved themselves in the last 3 years that banks has accepted according to a specific compliance protocol that we prepare for them. But at the end of the day, I never saw Bahamas as something very, very attractive. And I think that at the end of the day, if the regulator thinks that now by raising the bar, it will attract good brokers, I think it's a big mistake.
No, not good brokers necessarily, but just well-established brokers. Also, keeping the bad and the smaller ones out. I agree with you. This is purposefully done by the Bahamas to cap the number of brokers at no more than 40, and they do not want Bahamas to become like another Cyprus. Mm-hmm. They don't want to be the Vanuatu of offshore businesses here. The Securities Commission itself doesn't have the experience to regulate this space very well, and so this is something that they're doing in order for them to be, playing catch up, and perhaps in the future as more offshore jurisdictions either catch up on regulations or get trashed by the bad operators, that this will become the new norm. But I agree, it's not going to be a place where everyone just rushes to and gets a license. It's certainly not.
Tal, do you think that this is also in part like just a little bit of a money grab, that a regulator's worked out they've suddenly got something in demand and they can say make more money for less effort by raising that bar? And do we think that all the other jurisdictions might follow suit under the guise of let's make this more professional, but actually it's let's just make more money out of this?
Wow, I never thought about that. Oh, it's a good question, Graham. I really hope that that's not the case. And I want to believe that that's not the case. I know that like in Vanuatu, it also they started with the no capital requirement or 2,000 capital requirement, and then suddenly they raised it to 48,000. Okay, and then they spoke let's maybe ask for 500,000, but then they saw like the stir in the industry, or maybe I believe that was the motivation, and then they kept it on the 48,000. And now I really understand. I don't think that the regulator wants it obviously for their own money. It's like it's all they do it for the sake of the republic, for the government. I believe that if there was a demand for this product, and people will pay 400,000, 300,000, and everybody will win. The traders will win, the brokers will win, and also the public will win. I think it will be a good trade-off. But I don't really think. I actually agree with what Jim said. They probably do it on purpose to take. Because maybe they don't have enough people to deal with these applications. That's what I think.
Mm.
And
yeah, well, here's the thing to follow on from that is that all of these jurisdictions are under-resourced. The security regulators are less experienced. They're certainly not up to the quality that the UK FCA license would have. But what I've noticed in the industry is that there's been a change. Like Graham said, these brokers are going out and getting licenses wherever they can because they're trying to keep ahead of the regulatory change. They don't want to get caught behind in another ESMA situation. But the bottom line is, it's the brokers are only going to be able to serve the clients that want to come to their trading conditions, and the only way that they're able to do this is by to go offshore jurisdictions.
But doesn't the, you were saying before, Jim, that the CFD industry and the brokers that operate is actually really good for the economy in the Bahamas in terms of employment, in terms of economic diversification away from tourism. Is it then not kind of them sort of trying to cap the industry at only having 40 brokers? Doesn't that kind of go against that?
This has been the argument for the last couple of years. That's why it's taken such a long time to write these rules, is the balancing of the reputation of the jurisdiction and the ability to create jobs and to diversify their economy. And in this situation, they've had to look at the long-term effect to not implement more, or let's say more physical presence requirements. That would have been another direction that they could have gone to. Like in the UK, mind and presence, decision-making, management needs to be within that territory, not controlled by other territories. It could have gone that direction, but I think it's still a bit too early for a jurisdiction like the Bahamas in order to really put their arms around this industry.
We've seen a similar thing in the Seychelles, where it's a nice concept to believe that we can kind of empower the local workforce, build up the local economy, but you can only take that so far based on the employable manpower and skill sets, and even down to the internet available in these places. So as much as we've tried to invest as much as we can in the Seychelles, and we have a local office and we have local staff. For example, we were trying to find a local qualified compliance officer, but there were 30 new brokers coming in the front door in the last year, and there were probably 5 qualified compliance officers in the Seychelles, and maybe another 5 that were prepared to move there and enjoy the beaches. But that still leaves another 20 brokers unable to find qualified compliance. So the regulator was quite good. They've worked on some outsourcing rules that have just essentially meant that those 5 qualified compliance officers can each handle 5 brokerages instead of 1. And we've taken a long-term approach that we've also hired the closest we could get to a qualified compliance officer, and we're going to complete the end of their training and experience, so eventually their takeover. So I think, yes, it can add to the economies, and maybe it's not such a bad thing to say 1 or 2 of these offshore places can become the next Cyprus. But Cyprus had a lot more talent and a lot more connections to very highly skilled Israel, Russia, Europe, that some of these places don't. So I think it's going to be a case of which ones can control their own narrative and their own destination for long enough till they can boost the economy and bring the skills in. And at the moment, I think that's not quite clear. Certainly when we chose the Seychelles, we were given a list of sort of 5 to 10 jurisdictions, and it was as good as like throwing darts at it to pick one. Maybe now, as the rules are getting better, the resources are getting clearer, that list is becoming a bit more defined. But even as Tao said, it's still like, have plan B and here's 4 jurisdictions. We haven't got to the stage where 1 or 2 are clearly defined as the go-to places.
Graham mentions those challenges, that's local resources, certainly being able to comply with the rules there. But then there's the infrastructure, like you mentioned, the internet. But then there's also the other third-party resources that we all need, which is the banking. And that's often more of a driver to decision-making process than just having a jurisdiction that offers you pretty much run of the house. The banking and the third parties, because you find many of these jurisdictions also on different sorts of blacklists and gray lists and other OECD-driven, European Commission-driven lists, which becomes quite a challenge as well.
banking is huge. I think banking is the singular biggest point of offshore brokerages, that if you're looking at like good or bad, probably the best definition of good or bad is the good ones are able to maintain proper tier 1 bank accounts at globally recognized banks. And, you know, some of the bad operators are leveraging a white label payment provider on top of another payment provider, and, you know, are almost unable to move their own money around.
If you see what's going on in Seychelles, you know, I really agree with what you said, Graham, and also what Jim said. You go to Seychelles, actually now, when you visit there, you feel a bit like what Cyprus has been like 6 years ago. You see some Russian communities. If you go into Victoria, into the main city, near that traffic light, there's one traffic light there. You see lots of small offices of law firms, of accountants. Some Russians are working there and starting to operate and take off of the business, like what happened 6 years ago in Limassol. But the funny stuff is exactly what you said. Regarding banking, it's like a huge black hole there. You can work with BMI. What is BMI? Bank of Mali, Iran. So BMI has a branch, the main branch is Seychelles. But that's a problem, by the way, Graham, and I think I told you also, it's without the relevance of today's seminar. Part of the issue of Seychelles is getting good banks there. Now, getting good banks is not actually working with Barclays, which Barclays offshore units is very different to the Barclays that each one of us know from the UK. It's a different thing. Now, as Jim said, and also as Graham, the banking is the single most important thing. Now, many of the banks say, listen, we will go with a certain licensed entity only if it has other licensed entities in the group. That's one thing. The second thing, they need to work on a very strict compliance protocol as if they were regulated by a European government. And that's very interesting because that's part of the thing. If you get like value trades, like where you work, you have a UK licensed entity and you have a Seychelles licensed entity, and that is the things that become very common. I can tell you, most of our clients don't have only two licenses. They have 5 licenses. They have 4 licenses. And my suggestion is to take as much licenses and banks as you can. There is never enough of them.
So I would agree with that, and maybe I've learned from my own experience when ESMA came out. We were really strong in the UK, really strong reputation, and we protected that by not having other licenses, and then invariably saw a dip in business and were forced into the Seychelles, and now explore sort of other licenses of banking. So I agree that right now it feels like we should definitely get whatever licenses we can and definitely whatever banking we can. So I'm not saying don't do that, but I'm slightly curious. I've seen you mentioned exactly that a lot of these banks will look at, do you have better regulation or better processes elsewhere? If so, then we're open banking for your offshore. I've seen the exact same thing with credit card processing for Visa and MasterCard. If we can put it side by side with your European entity, fine, but we can't process standalone. So that I guess is a good filter of good operators, better processes. But I slightly worry that in theory right now you have, in our case, a UK entity that is established under FCA rules, following them very clearly. And we have a Seychelles entity that is established under FSA rules in the Seychelles, following those, operating in non-European jurisdictions only. So the two should be very separate. But because of the banking and payments, we're being forced to move them closer and closer together. Is there a danger that in, say, 2 or 3 years' time, they're as good as the same, and then ESMA wakes up again and says, hold on a second, I couldn't stop you doing something in the Seychelles, but I can definitely stop your UK or your Cyprus entity working with the Seychelles.
Absolutely. Absolutely. This happened in the gaming. This happened in the gambling industry. Exactly. What happened? If you had a regulated company under European regulation, and you had also a closely connected Curacao, Caribbean regulated entity, that really warned regulators around the world that you're in a big trouble. And that happened in the gambling industry, exactly what you said now. And in some cases, if you are a provider that providing services for European regulated entities, you cannot do it with clients who are not based in the EU. And that's exactly what you said. Now, a few years ago, everybody was surprised because they say, what does it matter? Well, what does it matter if this? But exactly, I think that what you have said, we are very close to that to a problem with that situation as well. Yeah.
And when Tal says get as many licenses as you can and get as many bank relationships as you can, I think what he's also meaning is don't just stop at getting your broker licenses, but get EMI, get payments, get e-wallet licenses as well. Any way that you can safeguard your organization by having as many relationships out there as possible. And this is just something that the bigger, well-established, the well-financed brokers can do. So I think at some point, we'll see a lot of those small brokers in some of those jurisdictions impacted because of that.
Absolutely, the EMI, exactly. We didn't touch it, but you can see like that's a really trend. Instead of opening like a new licensed broker, you get your EMI license in Lithuania, okay, and then you have your own SWIFT bank. You have your own SWIFT code, so you can be also a broker and also be a bank. It's not really a bank, but it's like a licensed payment provider, and that's a really interesting trend that started, I think, in 2019. In 2020, it continues to grow. Exactly what you said now, Jim, and that's a really good idea of diversification of the assets. Yes.
Definitely. And Graham, you were saying before, and I think, we've all touched on it, how important banking is, and in terms of influencing where brokers will go in offshore jurisdictions. Obviously, Value Trades chose the Seychelles, but were there other jurisdictions that you were also considering before you went to the Seychelles, and did the...
Yeah, so like I said, we had a list of about 10 jurisdictions. We actually had, through our shareholders, some other business in both the BVI and Belize. But in the end, the main driver for us to go to the Seychelles was the fact that we had a pretty strong banking relationship with Barclays in the UK. And at the time, they've now become ABSA and diversified. But at the time we were getting set up, it was Barclays Seychelles. And even though it was run very separately, and as Tal said, it definitely doesn't give you the services Barclays UK did, we at least had all our beneficial owners of the UK company had gone through Barclays compliance, which gave us a big leap in getting through the door and getting set up in the Seychelles. And we're now set up with what is now ABSA Bank in the Seychelles. And from a day-to-day banking perspective, it works fine. It's a bit of a kind of clunky service compared to what we're used to in the UK, but it does work fine. So in that sense, I'd say banking was number one on choosing jurisdiction. And even I remember just as we were, I met with Jim about the Bahamas, and he had a list of banks, but some being, for example, Australian banks. So it probably would work great if ASIC comes in with their regulations this year, and they need to go offshore, and all of a sudden the Bahamas is recognized by Australian banks. That would work well for them. But for us, it was just a whole new relationship, which was a lot harder than at least having the door half open. And I've seen with a lot of the bigger firms using this kind of power of existing relationship to try and set up the offshore banking, whether it's through the FX brokerage has a big franchise with a bank, or it's just shareholders having, their wealth and assets with a bank, helping sway that decision that the bank might open their offshore account.
Okay, and you were talking as well before about how ESMA might, as you know, banking gets closer and closer and less separate between sort of offshore entities and in Europe. How might that influence things going forward? Well, then if ESMA does come in and do that, will that drive brokers away from these offshore jurisdictions?
I think sort of looking back on what we've seen from ESMA in the past and some of what Tao and Jim has said, the mindset can't be, I've picked a good jurisdiction, I've got my brand identity there, this is what I'm invested in. The mindset needs to be much more dynamic. What do my clients need now? What can I facilitate now with the right regulation, with the right resources available? But don't expect that to be the same in the next 1 year, 2 year, 5 years. I think we're going to see kind of constant flux in the industry for a long time. Maybe COVID has slowed that down a bit, with some of the like regulatory creep being delayed. Maybe Australia's leverage restriction will be delayed because of that. But invariably, I think you're going to find constant flux, constant chasing the next best thing or running away from the worst thing, and probably a lot more solutions specific to a requirement. So you might find that offshore can still work for China, where China is a gray area anyway, but there's no way you can onboard European clients to high leverage offshore. So I think you'll start to see as well that divergence. So maybe the Bahamas, because it maintains a higher level of offshore reputation, it might still be able to attract European clients that can get higher than European leverage, but it shows no interest to a Chinese client. So therefore, you know, brokers that are big enough will just have to diversify and have 3 or 4 different solutions between like sort of super high strict UK, US, the lower end of well-regulated Cyprus, Australia, through to multiple different offshore regulations. And I think also one of the key things I've seen, touching on like what Jim said with the EMI, is I feel we're almost more a payment business now than we are an FX business. Maybe that's because we have a lot of experience in FX, so we can just turn it on and it works. But we spend a lot of time now working on payments, whether it's banking, whether it's credit card processing, whether it's just the whole channel from client to us. It's a lot of work, and there's a lot of regulations, whether it's PSD2, 5 MLL. There's a lot of regulation coming in that sense as well. So I think it's going to shift a lot of the resources of brokers and their consideration of offshore to become either I'm getting regulation to be a payment provider, or I'm not, but I still need that skill set to navigate the environment. I think that's probably the next biggest consideration in the market. What offshore works for payments?
I can also see it in our firm. You know, we are a law firm. I established my firm in 2003. We started with contracts between gaming providers and with platform providers. Now I can tell you 50% of our work is either banking or compliance. And we didn't touch compliance, but compliance is also a very, very important thing. You know, to make sure that the brokers pay their clients on time, do the KYC correctly, prevent money laundering. All of this is really, really, really consuming, and it's very, very, very important. So it's like the payments and the compliance now, I think, and I see it in the clients that we deal with, is the most important thing now.
This industry, what I've noticed about our CFD, FX industry, is that it has been very fast and very quick to respond to market changes. And from my experience there in the, from 2007, when the industry was just kind of first, getting on the main world stage, you see different iterations, different challenges in overcoming that, whether it was, marketing or, digital outreach, getting onboarding clients, the AML, the payment processors. There's always been a barrier, or it seems like each year there becomes a new barrier or a new obstacle. But at the same time, the industry is so quick to respond with solutions around it. It'd be very interesting to see what comes out in the next couple of years.
Definitely. And obviously, as I kind of said right at the beginning, when ESMA introduced its product intervention measures, it was a real boom for offshore jurisdictions, and a lot of traders went offshore and then brokers followed. In Australia, ASIC is, well, I think at this point it's kind of the consensus is that, ASIC maybe this year or soon should be implementing its own leverage restrictions, its own product intervention measures. And the regulator initially proposed that they were going to do 20-to-1 leverage on FX pairs, which is harsher than what ESMA introduced. Although I think from what I've been told, the regulators had a lot of responses regarding its consultation paper, which is why they have yet to kind of actually implement the measures. But Graham, do you think we're going to see any action with the measures actually being introduced this year?
So sat in the UK with a UK and a Seychelles broker, we do the rain dance equivalent of will ASIC get on with it and introduce their leverage caps. I think my key feeling on this that I'm quite passionate about is it's not necessarily about the leverage or wanting them to be sort of one thing to protect clients. Clients know what they want and they will go where they can get it. But what all the regulators around the world have done that I think is bad is they've created unnecessary regulatory arbitrage that kind of stops clients actually thinking about what's important and allows brokers to continue to push unfair or misleading messages. If it was a case of, let's say, G7 when flat 50 times leverage all on the same day, there would be a lot of clients who go, you know what, I like well-regulated brokers. I like to know my money's safe. I'll stay where I am. And there'd be plenty that go, okay, I'm going to go offshore. I like 500. But I now clearly understand that 500 is correlated with offshore and it's correlated with high risk. Maybe I'm not going to be treated fairly. Maybe my money is at more risk. But instead, someone will see that ASIC is quite close to UK, so they'll move there. But then even if ASIC comes out and goes more strict and goes 20, people might go, well, I'm in Australia, but I want to go to the UK because they're offering 50 times on Eurodollar, not 20 or 30 times. And it creates kind of an unstable situation and more problems. I think the ideal solution would be as many of the big regulators as possible getting together and having as close to a unified framework as possible, so we could have a clear, well-regulated G7 style or G10, and then offshore clearly at your own risk. But in fact, what has been happening, and I'm sure will continue to happen, is the exact opposite. Governments will either, favor their own locals, whether it's Cyprus, say, has such a big brokerage population, they're always going to try and look after their employers versus clients coming from other countries. You're going to have businesses that want to circumvent rules. So as I said earlier, I think the next 2 to 5 to 10 plus years is going to be brokers being dynamic and trying to get around the rules. And we've already seen some of the big Australians making some interesting move your clients offshore. Wait, we changed our mind, come back. So we know they're all set up and ready to go offshore as well.
And Jim, obviously you're here in Australia. do you think that, you know, like ESMA, when ASIC implements, you know, finally gets around to implementing its restrictions, you'll see more Australian brokers going offshore?
Well, certainly to keep the mix of clients that they have now. There are two different types of clients. There are the clients that are conscious about the regulatory safety of a tier 1 jurisdiction. And then there are clients that just want whatever trading conditions that they can get. And the fact of the matter is that brokers are making more money off of those highly leveraged clients, not because they're cheating them in any way, but it's because that's just what clients want. Those clients want. They want extreme leverage, and they want to win big or lose big. And survival in nowadays, you know, to be able to offer service to a wide variety of clients means that you have to be regulated in different jurisdictions. In tier 1 jurisdictions, to maintain the credibility of your broker, of your brand, and then have an offshore jurisdiction in order to push what happens to be most, you know, where most clients really want to be anyway.
I don't think there will be lots of brokers staying in Australia pretty soon. People still like the ASIC license, but many of my clients that have been regulated only in Australia since the beginning, you know, took and acquired more licenses, and some of them just left ASIC completely. They have a Cayman license, they have a Vanuatu license, some of them have Seychelles license, some of them also has European licenses, but many left Australia. You see, there's virtually no new licenses issued in the last couple of years, and it's a very small amount of licenses, and that's all for a reason. You know, probably, you know, they want to safeguard the public, and that's fine. But at the end of the day, you know, the brokers need to find solutions, and I still think that the model will have Australian, let's say a Vanuatu or Seychelles, but I like Vanuatu because I think it's better on the banking. You have a Vanuatu license on one side, you have a Estonian license for crypto on the other side, and then that is enough for banking. If you want, you can have another EU and a SISEC license for the European clients. But I think that structure for now is the basic. Then you can add more licenses. But if you see what's going on in banks like ICICI in Hong Kong, okay? If you show them that you have a Vanuatu license and you're working under strict KYC and AML policies, in many cases they will board you, even though, you know, it's an offshore license. So I don't think it's that a big deal if you have an offshore license. But the most important thing is to keep your reputation and make sure that you work compliant.
Mm.
And Jim, I hope I'm not throwing you under the bus, but you were having a conversation and you were saying how, like, a lot of, you know, we say ESMA introducing the leverage restrictions, ASIC introducing leverage restrictions was kind of a way for regulators just to basically say, we don't want to deal with the industry, either work within this framework or get out. And I was just wondering, what everyone else thought here. Do you kind of agree that sort of by pushing, so like ASIC wanting to do 20-to-1 leverage is kind of them saying, look, we don't really want to deal with you guys, either go elsewhere or meet these leverage restrictions. So I mean, and you know, meet these requirements. I'm interested to hear what everyone has to say. Oh, Jim's gone. He didn't like that question.
I'll leave that to Graham and to Tal. But yes, you know, I think that's what we saw with UK and ESMA. Is the fact is that from this industry they were getting most of their complaints, and they had the choice either to better regulate it or to regulate it out, and that's and that's the position they took.
I think one of the big factors there that might even determine some of the offshore jurisdictions you might choose is, you know, how big a factor is this industry versus alternatives. So, you know, at the end of the day, the CFD market in Australia onboarding loads of highly leveraged Chinese clients and then receiving massive problems with the Chinese government is not worth the risk to Australia's mining industry, that is tens of thousands of times bigger. Versus if you look at somewhere like Cyprus, where the CFD industry is a noticeable component of GDP, and they have no real trading relationships with China, they would happily onboard lots of highly leveraged Chinese clients, but then extend that to Europe. And, you know, Europe has a very highly regarded finance industry that those CFD complaints is bringing down. So they want, you know, rid of. So I think probably one of the considerations is, you know, is the CFD market something that a jurisdiction values? And if you can find a jurisdiction that knows what CFDs is and shows some appreciation for it, that's probably a really good thing and somewhere you should work with. And we have seen, for example, in the Seychelles, at least the regulator is upskilling staff, increasing staff numbers, willing to talk to us. They're all good signs that say, you know, they shouldn't just leverage cap and get rid of the industry. Versus if you go somewhere like ASIC, and we know there's a very frictional relationship between the brokers and ASIC, and the brokers can't even have straight conversations with them. Yeah, that's going to be a sign that they're not so invested in the industry.
So then is it fair?
Seychelles is amazing. You know, I was in Seychelles. I met the regulator. I came 2 people from my team. It was so easy to schedule a meeting. They're so inviting. Lots of also people there who are coming from abroad, from Australia, from New Zealand, living in Seychelles, working for the regulator there, for the FIU. And they're very accommodating. At the end of that, it shows that they do invest in the industry. Same goes, I think, also with Vanuatu, also with Cayman, also in Cyprus. As you said, the regulator is very connected to the industry. You see the regulator coming to speak in IFX Expo every year almost. And that shows the commitment that the regulator has for the industry. And as you said, in ASIC, it's very, very, very different. This, again, another reason why brokers are leaving Australia and will continue to do that.
All right, so that kind of concludes our discussion part, but we still have a few questions that have been sent through for the Q&A. And oh, Jim's gone again. He doesn't want to be part of the Q&A. But so I have, I'll ask the first question, and I hope that it won't divide you all too much. But the question is, which offshore jurisdictions are the most popular or best for brokers? So Tal, we'll start with you. What are your thoughts?
Yeah, so the most popular is Vanuatu. Number 2, I think, is Cayman, and number 3 is Seychelles. That is based on my experience as a lawyer representing brokers, and that is if I take into consideration the, let's say, the responsiveness of the regulator and speaking with the team. I think that's very important. And also, I think if you take in mind the cost of setting up and the cost of keeping everything compliant. And I think it has all of these jurisdictions. I think has a good trade-off between making sure that the traders are treated responsibly, but still gives all the features to make sure that the business keeps running. So Vanuatu, and then Cayman, then Seychelles. That is my 3 popular jurisdictions. And then you can put also Estonia as a crypto jurisdiction. That is my populars.
And Graham, what are your thoughts?
When we shortlisted our choices, we had the Bahamas, Cayman, and Seychelles. We didn't like Vanuatu. Maybe it's improving, but when we shortlisted a couple of years ago, we felt they'd had a bit of a bad rep. A few kind of early movers had gone there and caused a bit of a reputational issue. And then with some of the Bahamas regs coming in now, I would say Cayman and Seychelles.
And Jim?
they're all going to become the most popular because brokers are just going to need to get one license in another jurisdiction right after another, because they need to stay ahead of any regulatory changes. They always need to have the ace in the hole in order to serve their clients.
Okay. And the next question is, so do brokers still need regulated entities in tier 1 jurisdictions, or can they go alone to offshore only?
I'll go first on that one. I remember one of my first experiences in the industry was when Refco went bust. And that was when I first learned what the BVI was, and that used to be a really good jurisdiction until that happened. So right now, as Tal mentioned, I'd probably say no. And there's a trend of brokers getting rid of their expensive regulations and just choosing the cheaper, more efficient offshore ones. But that only works till the next Refco. And there will be the next Refco. And we're probably fortunate that market volatility now means brokers are doing well. We haven't seen problems yet. But at some point in the future, there will be an offshore broker that's somewhat under-regulated, that either runs away with client money or just goes bust through bad management. And the day after that, you're going to need good regulation somewhere else to maintain your reputation.
Agreed. Totally agree. You know, maybe if you start a broker, you can start with a Marshall Island company or with St. Vincent one, or maybe with the Vanuatu and Estonia. But then, end of the day, if you want to stay here on the long term, you'll have to get at least 1 or 2 companies, or at least one, with solid regulation, with good quality of regulation, and make sure that even the other, except the leverage, will be subject to the same compliance and AML rules. It's very, very, very important. You know, leverage is one thing, but making sure that the client's money is segregated is a different thing, and that should be all across the group. Very, very important.
And Jim, any thoughts?
Oh, I totally agree. You know, brokers need to establish a reputation with a tier 1 license. It may not be what the clients actually want, but you know, in a way, they're going to want to know that the broker, you know, has experience and the capability of you know, working within a highly regulated jurisdiction, and that's just the regulatory diversification is just essential for all brokers nowadays, and it'll just be better for the clients as well.
Perfect. And then there is another question which is talking about companies, brokers. So I guess, Graham, this one would be good for you to answer, is companies that are licensed in either the UK or EU, and then they have offshore jurisdictions. Obviously, at the moment, COVID-19 has provided a boost for revenues, but before then, when looking at brokers' reports, financial reports, their offshore operations were actually picking up a lot of the slack post-ESMA's product intervention measures. Do you think going forward that kind of once COVID volatility lessens, that will continue to be the case?
I think what we were seeing generally before COVID-19 caused some volatility was that the brokerage industry was not doing as well as it had done, and was just generally suffering from higher costs. So yes, you would see some more profitability in the offshore jurisdictions. Some of that is the benefit of higher trading volumes with higher leverage, but some of that is also just the benefit of less operating cost. So once the volatility goes away, you might see increased profits in the offshore jurisdictions, but I think overall there's still a challenge with overall profitability in times of low volatility. As we've all said, it's a good idea to go out and get lots of licenses, none of which come cheap, all require certain staff servicing them. So I think, you'll see sort of more balancing the books, people trying to shift revenues across their group, just to manage their cost base better.
Okay, and also another question is, so obviously you've been talking about some of, the most popular jurisdictions and what you think is the best. So, Vanuatu, Seychelles, Caymans, the Bahamas, etc. Is there any more unknown or obscure countries that are maybe sort of showing that they are going to become a more serious player in the future?
Yeah, if you see Dubai, the DFSA, we had some clients, we helped them get the regulations there. Some of them have a really nice Arab-speaking desk. They want to target Arab-speaking countries in the Gulf area. Some of them came from other places, from the UK, from Australia, from Cyprus, and they wanted to have a lucrative DFSA license. It's things that it's not that usual, but I recommend specifically for brokers that has a large presence in Arab-speaking countries to go on the DFSA license. And that's not very popular yet, and it might be more popular.
Yeah, I would second that. I think another sort of interesting trend is with Hong Kong more realigning with China. It's removing one of the sort of global banking centers. Singapore is seemingly constantly trying to maintain tier 1, and so also removing some of its banking services. So I would say the whole sort of Middle East region is an interesting area that has some reasonably well-developed local banks, some reasonably well-developed regulations, and would be an interesting place for more people to explore.
And Jim, what are your thoughts?
Oh yeah, I've heard of people getting licenses in pretty far off places lately, in South Africa and Kenya. There's even further abroad that you can go. But I think the trend will be coming back to those tier 1 jurisdictions, just simply because the infrastructure is there, and the clients are going to realize that that's where their money is safe.
All right. Well, that's all the questions that we have and all the time that we have today. So Tal, Graham and Jim, thank you so much for joining me. It's been a real pleasure hearing your insights on offshore jurisdictions.
Definitely been a pleasure.
Good to see you, Graham. Thanks, Tal.
Yeah, cheers everyone. Good to see you, and yeah, great for the audience, and hope to do more of these in the future.
Definitely. Well, I think if coronavirus, it's definitely made us all a bit online, and I think Zoom and all webinar hosting companies are doing very well. So we'll have to get you all back online for another discussion soon.
Yeah.
Thank you.
Cheers. Thank you.
Cheers.
Bye.
And to everyone at home, thank you so much for joining us today. And next week we'll be having another webinar as part of FMTV. So be sure to tune in next week. Okay, thank you. Bye, everyone.